Most people think inflation just means higher prices at the grocery store or more expensive bills each month. But its real impact goes much deeper than that. Inflation quietly changes how wealth is built, protected, and transferred over time, often benefiting people who own assets while putting more pressure on those living paycheck to paycheck. As money loses purchasing power, the old financial rules many people grew up with start becoming less effective, forcing a major shift in how saving, investing, earning, and spending actually work in the modern economy. Today, we will talk about how inflation is rewriting the rules of wealth. So before we get started, make sure to hit that like button, also subscribe to my channel 10. Most people think inflation only means higher prices. When people hear the word inflation, they usually think about groceries becoming expensive, rent increasing, or everyday costs rising. And while those are obvious effects, inflation changes far more than just prices. It quietly rewrites how wealth is built, protected, and transferred throughout the economy. The problem is that most people still follow financial rules designed for a completely different economic environment. They save, spend, and plan as if money itself stays stable over time. 9. Cash quietly loses power every year. One of the biggest hidden effects of inflation is the gradual loss of purchasing power. Most people focus on the amount of money they have instead of what that money can actually buy. A savings account may look larger over time, but if prices rise faster than the money grows, real wealth actually declines. This creates a dangerous illusion. People feel financially responsible because they are saving, but their money slowly weakens in value year after year. Wealthy individuals understand this deeply. They know that holding too much idle cash for too long can quietly erode wealth. 8. Inflation rewards asset owners more than wage earners. Another major shift caused by inflation is how differently it affects asset owners compared to workers. People who own businesses, real estate, stocks, or investments often benefit because asset values tend to rise over long periods. Meanwhile, wage earners usually depend on salaries that adjust much more slowly. Expenses rise immediately, but income often lags behind. This creates a widening gap. Owners of appreciating assets frequently become wealthier during inflationary periods, while workers relying only on labor income struggle to maintain the same lifestyle. 7. The middle class feels inflation the hardest. Inflation often hits the middle class hardest because they are squeezed from both directions. Basic living costs increase while wages fail to fully keep pace. At the same time, many middle-class families lack enough appreciating assets to benefit significantly from inflation-driven growth. Wealthy individuals often own investments that rise with inflation, while lower-income groups may receive some support systems or subsidies. The middle class often carries the burden through shrinking purchasing power, rising debt pressure, and reduced financial flexibility. 6. Debt behaves differently during inflation. One of the most misunderstood aspects of inflation is its relationship with debt. In some cases, inflation can actually benefit borrowers, especially those holding low fixed interest debt on appreciating assets. For example, if someone owns real estate financed with fixed rate loans, inflation may increase property values while the debt itself becomes easier to repay with devalued future dollars. Wealthy people understand this dynamic and often use strategic debt carefully during inflationary periods. Meanwhile, people carrying high-interest consumer debt usually suffer because rising costs reduce their financial breathing room. 5. Inflation changes the meaning of safe money. Many people believe safety means keeping money in cash or traditional savings accounts. But during long periods of inflation, safe money can slowly lose real value. This forces investors and savers to rethink what safety actually means. Wealthy individuals often focus on owning productive assets rather than simply storing money. Businesses, real estate, equities, commodities, and cash flow assets are often viewed as protection against inflation because they have the potential to rise alongside economic growth and increasing prices. 4. Governments and financial systems adapt faster than ordinary workers. Another quiet reality is that large financial systems usually adapt to inflation faster than ordinary individuals do. Corporations adjust prices. Investors reposition assets. Governments modify policies. Financial institutions restructure products. Meanwhile, average workers often continue operating with old financial habits while their purchasing power weakens. This creates another hidden transfer of wealth. Those who understand changing economic conditions early tend to protect themselves more effectively than those who react too slowly. 3. Inflation encourages spending and investing over hoarding cash. Inflation changes human behavior because people realize money may buy less in the future. This encourages movement of capital rather than long-term hoarding of cash. Wealthy individuals often respond by investing more aggressively into assets, businesses, and ownership opportunities. Average consumers, however, may respond emotionally by overspending or taking on unnecessary debt. The difference is strategic intention. One group positions money for growth while the other reacts impulsively to rising costs and uncertainty. 2. Financial education matters more during inflationary periods. When inflation rises, financial ignorance becomes more expensive. People who do not understand investing, asset ownership, debt structure, or compounding often struggle more because traditional saving habits stop working effectively on their own. Wealthy individuals usually spend more time understanding how economic systems operate, because they know financial rules change over time. Inflation rewards adaptability. Those who continue following outdated financial assumptions often lose ground quietly without fully understanding why. 1. The real rule change. Wealth is increasingly built through ownership. The deeper truth about inflation is that it quietly shifts the economy toward ownership-based wealth. Simply earning and saving money becomes less effective over time compared to owning assets that grow with inflation. Businesses, investments, real estate, intellectual property, and scalable systems increasingly become the engines of long-term wealth. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.